Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, July 28th, and I'm recording this from my office in Purchase, New York. Approaching the dog days of summer, equity investors seem once again to be falling into a sense of complacency and embracing the Goldilocks thesis, emboldened by the market's ongoing resilience and the consistent success of buying the dip. To wit, passive indices have ground higher to new records, and the stock market's volatility gauge remains benign. Meanwhile, the most speculative corners of the market have begun to lead, and even so-called meme stocks have reemerged. The cyclical to defensive ratio is at an 18-year high, suggesting optimism around the economy, and a measure of cash on the sidelines is at a 25-year low, with retail inflows topping $75 billion in just the last 3 months. In aggregate, this has left the S&P 500 index at an extremely expensive level. Now, while we understand that valuation, sentiment, momentum, all on their own are not reasons for caution, it is the composition of the rally that suggests to us some near-term risk as well as some opportunities. First, on the risk side, we see that concentration has returned with a vengeance. In the S&P 500, for example, the 10 largest companies now once again account for more than 34% of the total market cap, and only 5 of the Magnificent 7 stocks have gained in 2025. The Mag 7, by the way, are collectively in the middle innings of their multi-year CapEx boom around generative AI data centers. They currently account for 30% of S&P 500 CapEx, but only 20% of its profits. Capital intensity is shifting, with the asset-light business models growing less asset-light. Lastly, further below the surface, market breadth is also weak, with only 9% of companies recently at 52-week highs, a shockingly low figure. This brings us to the opportunity side of the equation. Here, stock picking offers the advantage of exploiting the wide divide between the highest flyers and the rest of the market. Consider that among the 493, valuations are much more muted and expectations are more achievable. The potential for differentiation is strong, which opens opportunities for two-way trading and hedge fund strategies. Consider that there are mixed signals and headwinds to the economy. The consumer side, for instance, is exhibiting pain in areas like airlines, restaurants, and hospitality. Other companies have discussed the cost of tariffs and the challenges around managing their global supply chains. And still others, like those in financials and fintech, are suddenly benefiting from an aggressive deregulation push. So overall, the way we see it, market leadership is changing. And the recommended way to play this is not through the passive, overvalued, and concentrated index, which focuses on the winners of the past. Now is the time for a proactive, diligent, and stock-selective approach. We're looking forward to the transition that may leave the index stalled in the intermediate term while the rest catch up. Given this backdrop, investors should consider adding long-short hedge funds and stocks with potential for upside surprise in earnings and cash flow. They may be found in select tech names and other areas like financials, industrials, energy, and parts of healthcare that will be policy beneficiaries. Avoid the overhyped themes and complement with diversifying positions in international equities, commodities, and energy infrastructure. As always, thanks for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.